Hi, this is Deborah Myers from Deborah Myers Bookkeeping Services on Maui, and this is Getting Started with QuickBooks Lesson 1, Part 2. I want to go back to all the accounting you need to know. If you're starting a company for the first time, I would advise that you get a good bookkeeper or your CPA to set up your accounts initially. This will save you thousands of dollars at the end of the year because you won't have an entire year of mistakes. If you know what's a cost of goods and you know what an expense is and what the difference is, then it'll be easier for you. But I highly, highly recommend initially you get a trained bookkeeper who understands to set up your accounts. It will save you a lot of heartache, headache, and money, especially when it's time to get a report for your taxes or for the bank or a vendor. Okay, so now we're going to go back to all the accounting you need to know about the chart of accounts. Let's look at that in our QuickBooks program. Right now we're using QuickBooks 2011. QuickBooks 2012 will come out soon. But so your chart of accounts, if you go to list, it's a list, and there's your chart of accounts. So you see you have your bank accounts there, your your accounts receivable, that's money people owe you. Your current assets, that's something that you can liquidate within a year. Fixed assets, that would be the building, the cars. Accounts payable, money that you owe. Your credit cards, current liabilities, loans. Long-term liabilities would be loans. Current liabilities could be short-term loans and payroll tax. Something that you're going to pay within a year is current. Long-term is over a year. Equity, that's your money. That's the money you put into your company to start up. That's the money your company has retained throughout the years, whether it's income or loss. That would be your equity account. So income, when you're selling something, whether it's a service or a product, that's your income. Cost of goods sold. Well, what did it cost for you to make this income? And this is different than expenses, and I'm not going to go into the details of that here. You would either hire someone to set you up, and I highly, highly, highly recommend it. And the great thing about QuickBooks is you can almost always change, if it's an expense, you can switch it to a cost of goods. So it can be fixed. But rather than have to fix it, it's better to do it right from the beginning. And then the expenses. And then other income and other expenses, if you have, let's say you have a retail store, but you also get a royalty income, then that would go into other income. It would be different than from the retail store. Okay, so this is your chart of accounts. Let's go back to our lesson. Okay, so it's a complete list of all your business accounts and their balances. So if it's not seeming to fit here we go. So the balance in our sample company's checking account is $49,969.10. And this information would also reflect on your balance sheet report. So if you have a balance here, then it's a balance sheet report account. If it's income or expense, cost of goods sold, those show up on the profit and loss report, which is the one you'll probably use the most, and they do not reflect a balance. And this is the balance as of the day that you've opened QuickBooks, and whatever information you have entered. It's as current as the information you have put in. Okay, so let's go back to our lesson. When you keep books for a company, you want to track where your income comes from, where you put it, what expenses what your expenses are for, and what you use to pay them. You track this flow of money through the chart of accounts. Assets include what you have and what people owe you. Liabilities is what your company owes to other people. Equity is the difference between what you have and what you owe. Equity equals assets minus liabilities. So let's go back to our company. So we have our assets. That would include inventory would be a current asset. Okay. So you add those assets up, you subtract what you owe, and the difference would be in your equity account, which is up here. And that's the total value of the, not the total value. Let's see how they worded it. That is the difference between what you have and what you owe. Okay, so equity equals assets minus liabilities. And I'm sure there's better descriptions for this, but I just need you to be able to use your QuickBooks. So we'll go on. All the accounting you need to know. So as you can see, there's more accounting that you need to know. But anyone can use QuickBooks. QuickBooks is made for everyone. Cash versus accrual bookkeeping. Cash basis. Income is recorded when money from sales is received and expenses when bills are paid. Accrual basis. Income is recorded at the time of the sale and expenses when you receive the bill. Okay, so let's talk about the cash basis. And that's real important to us in the state of Hawaii. Because in the state of Hawaii, we have to pay a general excise tax. And we pay that general excise tax on a cash basis. So if we've invoiced a customer for $100 and they've paid 50, then we would owe GE tax on the 50 that we have paid. That's a cash basis. Now, if you're accounting on an accrual basis, then you would count the whole $100 as income at the time of the sale. And if your customer should never pay you, then you would count it as a loss and offset it that way. And so that's the difference between cash and accrual. Cash is as the cash comes in and as the cash goes out, exactly. Accrual is when you have bills that you're going to pay and you've entered the bills, and that'll go in as an expense now. Well, I'm not going to retape this whole video for this. But, okay, so income is recorded at the time of the sale and expenses when you receive the bill. So in the cash basis, when you pay the bill is when you incur the expense. The accrual basis, when you receive the bill, is when you incur the expense. When you create your reports in QuickBooks, you can change it. So a lot of people have their business running on an accrual. Let's do a report. Let's do a profit and loss. Most businesses run on an accrual basis. And let's pretend he was in Hawaii and he wanted to pay his GE tax and he needed this report on a cash basis. So you select Modify Report, Report Basis, Cash. Okay. Now this should change to the word cash. Now it's on a cash basis. So it's no longer, the income no longer reflects what you've billed. It only reflects what you received. Okay. So it's modify report, report basis, accrual, or cash. I'm going to go back to accrual. Now QuickBooks will automatically go back to accrual even if your company, or oftentimes when your company is set for a cash basis, because that's how it runs the report. So if you need that report to reflect a cash basis, you go into modify and you change the basis of the report. Okay, so and that's what that is. Measuring business profitability. The balance sheet. A snapshot of your company on one date. It shows what you have, your assets, what people owe you, what your business owes, liabilities and accounts payable, the net worth of your business, equity. So let's go look at that. Remember when I said on the chart of accounts, if it had a balance here, it was going to show on your balance sheet? So reports, company and financial, balance sheet. There's a lot of different ways to get to this report. There's a report center that's wonderful that would take up a whole video of its own just to show you the different reports. Okay, so here's your balance sheet report, and this is going to be exactly the same as that list as far as the balances and the different accounts. So you're checking your savings.